Um, who can I pick on today to say the Pledge of Allegiance? Who would like to say the Pledge of Allegiance?
Judy, are we good?
Yes, Scott, we're on? Is
Yeah.
audio? Yeah. Okay, we're good.
Richard, would you please lead us to say the Pledge of Allegiance this morning?
Sure.
Thank you.
Glad Judy's got a flag there too, by the way.
Right, that's great.
Ready? Begin. I
pledge
pledge allegiance
to the flag
of the United
States of America,
and
to the republic
which it
stands,
one nation,
under God,
indivisible,
with
liberty and
justice for all.
Oh, thank you.
Hi, everybody.
Hi. So, according to Judy, we haven't received any public comments. So, I think that we could just jump right into our closed session.
I suggest we do roll call first, please. If I had to step away for a quick second, but I don't think you could have done it that fast.
We didn't used to do roll call for a while, but I guess with Zoom we should do it. Okay.
Yes.
Okay.
Ms. Schattmeyer?
Here.
Ms. Forrester?
Here.
Ms. Cavanis?
Here.
Mr. Parker?
Here.
Ms. Smith? Kathy Smith? Oh, she's
I
muted.
was there.
Sorry, I'm here.
Mr. Cromer?
I'm present. Good morning.
Mr. Knudsen?
Here.
Ms. Harris?
Here.
Mr. Shoemaker?
Here.
And Mr. Jurdy?
Here.
Thank you. All present.
Okay. So let's go into closed session.
Okay.
Judy, let me know when I have the green light, please.
Mm-hmm.
closed session item, anticipated litigation direction was given to staff and council.
Okay, after this, I would recommend we take a break to 10:25, be back here at 10:25.
Sounds good.
Yes, Madam Chair.
Okay. at 10:27. We have 4 possible action items on our agenda. The first one being the error correction policy. And could we have a motion?
I move that we adopt the error correction policy.
I second it.
Is there any discussion on the motion? Seeing none.
Yes,
Yes, okay.
Catherine. Well, I brought it up in closed session and wanted to continue it here about the way it's being shown in the policy history is revised overpayment policy and restated as an error correction. And when I read this, I thought it was so different that we're really introducing a new policy rather than adopting or correcting and revising an old one. I just wanted that noted as if there's a way that we could restate the history for a later date.
We could make a change saying that this rescinds the prior policy and replaces it with the new one and just swap out that little language at the bottom. Jeff, would that work?
Yeah, I was going to suggest at the very last line before the date that it say the board reviewed and replaced instead of revised. Does that address your concern?
Yes.
Okay, we'll make that change.
Okay, is there any further discussion on the motion? Seeing none, I'm going to do a roll call vote. So all those in favor?
Aye.
Judy, can
I'll take a roll call vote.
Judy.
Ms. Shatmeyer,
Yes.
Ms. Forrester,
Yes.
Ms. Cavanis,
Yes.
Mr. Parker,
Yes.
Ms. Smith,
Sorry. Yes. Takes me a while to get my mute off.
Mr. Cromer,
Aye.
Mr. Knudsen,
Yes.
Ms. Harris,
Aye.
and Mr. Jurdy.
Yes.
Thank you. Approved.
Motion passes unanimously. Okay, moving on to agenda item 3, the resolution 2028 implementation of Alameda decision. Is there a motion on that resolution?
Catherine, I suggest Doris give us a brief overview first.
Okay, yes.
Resolution 2020-08 covers how we will address implementation of the Alameda decision. It follows our error correction policy that was just adopted as far as our process and procedure. We will correct for contributions taken on the disallowed pay codes for active and deferred inactive members going back to the date of the PEPRA change, January 1, 2013. We will correct retirement benefits after the 1/1/13 date that had the newly disallowed pay codes included in the final average salary computation according to the process outlined in the policy. If there are any questions, I'm happy to go into more detail.
Yes, Julie.
Just a comment or question. This affects the probation employees, but does this affect other employee bargaining units? I'm not aware of who's on standby.
It affects 3 bargaining units. If I recall correctly, that would be the Deputy Sheriff's Association, the SEIU group, and one other whose acronym I don't recall right now. But yes, it affects us people throughout the entire organization.
Thank you.
Is there a motion? Oh, Quincy.
Just for the benefit of anyone that may be listening, it's my understanding that the
staff intends to notify each individual member whose benefits may be impacted by these changes. Is that correct?
That's correct. If a retired member's benefit is impacted by this, they would receive the notice of correction indicating what the change to their benefit would be related to this.
And just to make it clear, if I may, through the chair, the reason that this resolution is before you today is because of the Alameda decision. And at the time, this board adopted pay codes implementing the PEPRA legislation back in 2012. It had included on-call and standby, and some of you were trustees at that time, and we had open discussions about whether or not to include those. The systems were split on it, and this board thought, because there were legal arguments in terms of vested rights, that the more prudent course of action was to follow the past practice and continue to include on-call and standby, and anticipating possible litigation. And that's what's happened all these years later. And the California Supreme Court has said that those items, on-call and standby, the impact of the decision is that those should be excluded. And so that's the basis for this resolution and the proposed changes.
Thank you, Jeff.
Thank you.
Any other questions? Okay, so is there a motion for resolution 2028?
I'll move to approve the resolution implementing the California Supreme Court's Alameda case.
Second.
Thank you. Any further discussion? Okay, we're going to do a roll call vote. Judy, would you please do it?
Yes. Ms. Schotmeyer?
Yes.
Ms. Forrester?
Yes.
Ms. Cavanis?
Yes.
Mr. Parker?
Yes.
Ms. Smith?
Yes.
Mr. Cromer?
Aye.
Mr. Knutson?
Yes.
Ms. Harris?
Aye. Excuse me.
And Mr. Jurdy?
Yes.
Thank you. Approved.
Motion passes. Thank you. Next on the agenda is resolution 2020-09. And Doris, do you have any further explanation on 09 for us?
Yes, thank you. Resolution 2020-09 is the updated compensation earnable pay resolution that now moves those on-call and standby pays from includable to excluded. Additionally, there is a new pay code being added related to the Family First Coronavirus Response Act for the county to track the two-third pay extended FMLA for childcare. So those are the two changes in this version of the ordinance.
Lee, did you have anything to add? No?
No.
Okay, we'll go forward. And is there a motion?
I will move to adopt resolution 2020-09.
I'll second.
Okay, any further discussion on the motion? Judy, would you please do a roll call?
Ms. Schotmeyer?
Yes.
Ms. Forrester?
Yes.
Ms. Cavanis?
Yes.
Mr. Parker?
Yes.
Ms. Smith?
Yes.
Mr. Cromer?
Aye.
Mr. Knutson?
Yes.
Ms. Harris?
Aye.
And Mr. Jurdy?
Yes.
Thank you. Approved.
Motion passes. Okay. Our next resolution is 2020-10, defining pensionable compensation pursuant to Government Code Section 7522.4. Doris.
This resolution updates the compensation for our PEPRA membership. This ordinance or resolution only has the new pay code for the coronavirus extended FMLA. The other codes had never been included for our PEPRA membership. So for compensation for the PEPRA members, pensionable compensation, it's just adding the one new pay code.
Okay, thank you. Is there a motion?
I move that we adopt a resolution 2020-10. I think that's all I need to say.
Is there a second?
I'll second the motion.
Okay. Is there any further discussion on the motion? Judy, would you please do a roll call for us?
Yes. Ms. Shatmeyer?
Yes.
Ms. Forrester?
Yes.
Ms. Cavanis?
Yes.
Mr. Parker?
Yes.
Ms. Smith?
Yes.
Mr. Cromer?
Aye.
Mr. Knudsen? Oh, you're muted.
Yes.
Thank you. Ms. Harris?
Aye.
And Mr. Jurdy?
Yes.
Thank you. Approved.
Motion passes. Next on the agenda, we have Greg and Claire here from Callan to go forward with our quarterly investment performance report and other investment matters. Hi, welcome.
They're connecting.
Okay.
Give them one moment here.
Pretty.
Hi, Jay.
Hello. Just trying to get my video to work here.
Okay.
There we go. Good morning.
Those are nice pictures they have.
Yeah, they're nice.
Professional, yes.
Yes.
You can tell who's got the better home audio, can't you?
Uh-oh.
You may have to do the whole thing.
Okay. There they are.
Oh, hi, Greg.
Hi, everyone.
Hi.
Hey, Greg.
Aye.
Well, it's good to see you all.
See you.
You too.
I hope everyone's staying safe. Are the fires close to anyone up there?
Close to my daughter in Windsor.
Let me look out the window. See.
Hi, Claire.
Hi.
Hi, Claire.
Hi, everyone. Nice to see you.
Hi, Claire.
Greg, I was mentioning to Geraldine earlier, we had a very small one about a mile from me and a mile from her, half mile from her yesterday.
Oh, no.
But it was out early, put out early.
It got taken care of?
Mm-hmm.
Wow.
Thankfully.
Crazy.
Our firefighters getting better and better at getting them out quickly.
Yeah.
Well, I still credit Richard Shoemaker with the fact that we still have bombers here at our airport. And they have saved my house 4 times in the last 40 years. So
Wow.
Wow.
Quite amazing.
Oh.
I don't know if Richard's
Well,
on, but they were going to, yeah, there we go. I was going to say they were going to close the base and Richard led the opposition.
Thank you.
Air attack.
Yep.
Okay, Callan.
Okay. Well, I hope everyone stays safe and healthy up there. Sorry we can't be there in person. Hopefully we'll be able to see each other in person sometime soon. But we miss doing the drive. We miss coming up and seeing you. So we'll do our best to keep you engaged and keep the ball rolling here today. I know you've already been on these video conferences for a couple hours, and they can be hard to focus on for the entire time, and we completely understand that. So we have really two discussion topics for you today. The first is to go over performance, second quarter performance. And it was quite strong, rebounding from first quarter's drawdown. And then we have Jay Klepfer, who's going to talk to you about different ways you can manage the equity portfolio, the U.S. equity portfolio. And to refresh your memory, a few quarters ago, we did a asset liability study where we came up with and decided how much money to have in each asset class. And in addition to that, we decided to fund infrastructure and increase diversifying assets a little bit. And after the asset liability study, we're now going through each asset class in succession to say, should we be doing anything different for each asset class? And today we're talking about domestic equity. Okay, so that's the agenda we have. And should I share my screen to walk through the presentation? Is that the best way to do that?
I think that would be good. How about, is everyone good with that, or? Yeah. We agree on that.
Okay, great. Okay. There we go. I think that's it. Okay, so I'm going to provide a little bit of backdrop on the economy and capital markets, and then Claire will walk through specific performance results for your plan. On page 3 here, we'll note that there's been a huge rebound in capital markets since the bottom of the market in March. And you'll see in the first quarter, US stocks were up 20-some%. International stocks up meaningfully as well, though not quite as much. And bonds even eked out a positive return of about 3% for the quarter. Real estate was surprisingly stable, and there are a few different measures for real estate. But it's our point of view that there's likely to be further write-downs in real estate that have not yet fully gone through the market here. And then inflation was actually deflation in the quarter. So that's the quarter. If you look out over longer time periods here, let's just look at the 1-year and 5-year time period. There are a couple important trends to take a look at here. One is that if you look at small cap stocks, the Russell 2000, it is meaningfully behind large cap stocks. So for the year, it's 1 year ended March, it's actually negative 6%, even though the large cap stocks are up 7.5%. So where we see the big headlines today, the S&P 500 at all-time highs, that's largely driven by very large cap stocks, and it is not the average stock in America. Second big trend is international stocks remain negative, and meaningfully so relative to the US market. And then bonds have returned an awful lot, and more than we ever thought they would over the last 12 months. Now, I mentioned that today the S&P 500 is hitting all-time highs, and it's really interesting to look at how quickly the market rebounded from our sell-off in March. So the yellow line here is the drawdown and rebound of the stock market for this crisis. And then if you look at the green, that's the global financial crisis, and blue is the tech bubble. Those crises were much longer and much deeper. This one is a much quicker rebound in market price. But we all know what's driving this is a healthcare crisis, and at one point a financial crisis and an economic crisis. And we're a little nervous because we don't think all of those crises have been resolved yet.
Yeah.
And this is what we get to a little bit on this page, where the pink line here, this is the S&P 500. Look at the unemployment rate, consumer confidence, treasury yields, retail and food sales. The S&P 500 is well out in advance of these other measures of how well the economy is doing.
Wow.
And why on earth would that be? Well, the number one reason is a mass influx of liquidity from the Federal Reserve. So here are QE, quantitative easing metrics from the Federal Reserve, and the Fed's pumped $3 trillion into the financial markets. On top of that, we've had stimulus from the Fed, I'm sorry, not the Fed, from Congress, so fiscal stimulus, in the tune of about $2 trillion. And $2 trillion is about 10% of GDP. And that's doing a lot to prop up the markets, as well as, to some extent, the economy. Even with a 10% stimulus, now admittedly not all of it is in the market completely right away, or the economy, I should say, right away. Even with that, we still posted a negative 30% GDP annualized in the second quarter. So a lot of times, if you look at the pricing for the stock market versus the bond market, they move in a way that both tell you a similar story about what's going on with the economy. The line at the top here is the stock market, so stock market returns going up. And the line at the bottom is treasury yields staying flat, or coming down sharply and then staying flat. So the staying flat part for bonds generally indicates that the bond market thinks we're going to be in a recession, or rates are going to be low for a long time, and growth is going to be low for a long time. So these two measures seem to be telling you something about the economy, and that there's something, they seem to be telling you two different things about the economy. The stock market up, economy must be good. Bond yields low, economy must be bad. But this time, what we think it's actually telling you is that there's just a massive amount of money being pumped into the capital markets, and it's driving up the price of all assets. And it's not so much about the economy. And we mentioned that GDP remains weak in the United States, though it has been improving, but coming off a pretty low level. So GDP for the first quarter down about 5%, and I mentioned that negative 30% annualized return for the second quarter. And I think we mentioned this before, and I think you all know that when you say a negative 33% number, that's an annualized number, which means it's down about 8% in the quarter. And then the economists say, okay, if this perpetuated for a year, that's how we get that negative 30-something% number. Putting the most recent, this recession into perspective, we have this chart here we borrowed or stole from JP Morgan, who comes out with these statistics that we like to borrow when they have a chart that just tells the story really well. The size of the circles here indicate the size of the recession that you're going through. And then how high up and down on the scale indicates how long the recession lasted. So right now, there are only a couple recessions that rival this one in terms of size. It's post-World War II demobilization, and then the Great Depression. So our current recession is much deeper than the global financial crisis. And to date, it's much shorter, but this clearly hasn't completely played itself out yet. So now we're going to spend a few charts looking at capital market performance. And there are just a few takeaways that I think are useful for you. And here, this slide here, we talk about the US stock market. And the takeaways I think that are important to you are the one-year return slides down here, where you see large cap growth is up 23%, and value is actually down 9%. And small cap is down 5%. So this market has become very concentrated. There are 5 large tech companies that were up 35% in the second quarter. Today, one of those, Apple, exceeded $2 trillion in market cap. Think about that number for a minute. That's 10% of GDP. We said that a few minutes ago. And if you take those 5 companies, they are now bigger than any other stock market index in the world. So those 5 companies are bigger than all the stocks in the United Kingdom, all the stocks in China, all the stocks in Germany individually. So this stock market run-up has been really concentrated, and those investors who focus on those type of stocks are looking really good. Those investors that focus on not those 5 stocks are not looking as good right now. We've seen run-ups like this before in the tech bubble, and you don't know how long they're going to last. You really don't know, and there's no way to know. But they can't go on forever, because these companies cannot become 50% of our economy. It just won't work. So the question is, why? When will it change? And we don't know. And then what do you do? How do you stay diversified and not overly concentrated? Just a few names. So this chart here kind of gets to the same point. Here are returns through July, and the top 10 companies are up about 10%, and then the top 50 are up 2%, and then everyone else is negative from there. And it's a pretty linear relationship. Internationally, stocks rebounded nicely, though they still lag the US a little bit. There's a lot of talk about the dollar right now. So us investing in international stocks, those stocks are denominated in foreign currencies. If the dollar goes up in value, it's not good. If the dollar goes down in value, it's good for those stocks, the valuation of those stocks. So there are a number of things that are changing right now that make some people think the US dollar will end its 10-year bull run. One is the interest rate differential in the United States is not as great as it used to be with us cutting interest rates so much. The other is the perception that we're not handling the pandemic as well as other countries. And for that reason, we're going to lag coming out of the pandemic relative to other countries. And then the idea that the US is not the sole #1 unrivaled country in the world anymore. So more of a geopolitical comment there. So for those reasons, a number of people are currently predicting that the US dollar is not going to continue its 10-year bull market anymore. Fixed income returns in the quarter were extremely strong, and in particular for corporate bonds. And so here you'll see high yield bonds were up about 10% for the quarter. And for that reason, your active bond managers had a pretty good quarter. Final thing we'll talk about here is real estate. I mentioned there are a few different indices for real estate. One is this thing called the NCREIF Odyssey. So that's all of the core open-ended institutional real estate funds out there. And for the quarter, they were down about 1.6% on average, 2.5% appreciation decline, 0.9% income. So there is a start to the repricing of real property, but there hasn't been a full repricing yet. Industrials in particular are holding up well, but things like hotels and retail, we anticipate there'll be more write-downs in the future in this. So why haven't we seen any write-downs yet? The reason is we haven't seen a lot of appraisals yet. So since COVID, the amount of real estate transactions has plummeted, and you need those transactions to actually price the real property going forward. And so for that reason, there's this lag, this pent-up lag in private real estate right now. Okay. And with that, we'll start talking about your plan. And I'm going to turn it over to Claire to walk through the next few slides.
Great. So kind of the big headlines, as Greg already mentioned, are that Q2 was a pretty phenomenal quarter for your plan. Now, Q1 was a very dramatic quarter as well. But on slide 23, we've captured total plan growth over a bit of a longer history. So putting that into perspective of the longer history. Now, notably, June 30 marks the end of a fiscal year for your program. So at the bottom of this page here, we show the asset growth for the plan, the total plan over the course of the last fiscal year. Including those two very dramatic quarters, the plan saw about $6 million in growth. So started the fiscal year at $532.5 million, saw an aggregate $15.7 million in investment gains, paid about $9.8 million in benefits, and then ended with $538.5 million. You can see in the net new investment column there a fair amount of money that moved around throughout the course of the year. That captures all of the rebalancing work that Robert executed amid the market volatility to ensure that the plan stayed right on target, actual asset allocation in line with the strategic target and within the specified ranges in the investment policy statement. So in total, generally, money moving out of fixed income, which of course turned in positive returns in the market volatility of the first quarter, and into international equity, which was the hardest hit from a return perspective. So the furthest out of line from strategic policy. The top half of the page here looks even further back. So this looks at total plan growth over the last 15 years. And as you can see, the plan has more than doubled in the last 15 years. So that's pretty notable asset growth. And that's net, of course, of paying about $10 million a year in benefit payments. Now, consistent with Greg's comments on the market volatility we've experienced of late, if you look to the far right on this top chart, you can see how that's affected the total market value of your plan. And if we think about just the last 2 fiscal years, we've seen a dramatic decline for 1 quarter in each of those fiscal years. So at the end of 2018, the plan saw a 10% decline, then subsequently recovered in the following 3 or 4 quarters. And then, of course, in the first quarter of 2020, an almost 16% decline, which was nearly recovered in the most recent quarter, ended June 30. So including July, which was another positive month, the plan is just about back up to that high water mark where it was at the end of 2019. On slide 24, we look just at the actual asset allocation of the plan versus the strategic target. Again, the big headline here is the plan is right in line with that strategic target, and that's not by accident. Of course, that is including all of the rebalancing work that Robert has executed over the last couple quarters. And I always look at that percent difference column on the bottom, second from the right. That just shows the actual allocation percent difference from its strategic target weight. And again, as you can see, the plan is right in line with that target. Now,
Claire?
of course, yes.
I'm doing the iPad along with watching what you're doing on my computer, and my numbers are not the same as yours. Am I following him properly, or?
Oh, you know what? You might be on the performance report, the full performance report.
That's what it is. All right.
Yeah. So if
Arthritic
you pull up the
fingers
summary
don't
presentation.
select as well. Okay, thanks. There we go.
Yep, and we're on slide 24, moving on to 25 here in a second. So the last comment I want to make here is that the target asset allocation, of course, will include that new allocation to infrastructure as it's funded, as that capital is called by the investment managers. As a reminder, that'll be about 6% of the total target in full. I'll skip 25, which just looks at actual asset allocation and target over time. 26, we look at this just about every quarter. The big headline here, of course, is that you have more public equity than other public funds in the peer group here. That was a positive in the recent quarter, given the strong returns out of public equity. Slide 27 shows all of the detailed asset allocation by manager and by investment category, and how that changed over the recent quarter. So from the end of March to the end of June. And captured at the very bottom on the last line is the planned growth over the last quarter. So at the end of March, following equity market declines, the plan was at $466 million. Just in the second quarter, the plan saw over $74 million in investment gains. About $2 million flowed out to pay benefits. And again, we ended at about $538.5 million. The other thing that I check on this page is that when you look down within each asset category, that the growth and value managers are in balance, which is what they're designed to be, which is how the plan is designed. And that is certainly true. So Boston Partners and Harbor Cap, each in equal weighting within large cap, within mid cap, Fidelity and Janus, each about 2.5–3% of the portfolio. Same in small cap, value and growth and balance. The international equity managers very much in balance, each around 5% of the total portfolio, and then domestic equity and fixed income balanced as well. Same with real estate. So everything in good order there. Again, that net new investment column capturing both cash raised for benefit payments in the quarter, and also the end of the rebalancing activity that occurred at the end of March and flowed into the beginning of April, as well as any other movement in the quarter. Slide 28, we finally get to performance here. As we've mentioned a few times already, performance in the quarter was pretty phenomenal for the total fund. The total fund was up 15.87% just in the quarter, well outpacing its benchmark, which was up 13.57%. And that landed in the 5th percentile of the peer group. So well outperforming the benchmark, well outperforming peers. And as we'll see later on, every asset category, domestic equity, international, fixed income, real estate, et cetera, every asset category did outperform its individual asset class benchmark. Over longer time periods, performance versus peers remains great as well, very strong. The last year, of course, being the last fiscal year, a positive just about 3% return for the last fiscal year. So including the volatility that we felt, still a positive return. And I think that's actually the most striking thing on this page is given the market volatility that we've experienced in the last year, in the last 2 years, every single return on this page is positive. Over the longer 10 and 15-year time periods, the total fund has landed in the top decile of the peer group. over 10 years, just shy of the strategic target, and over 15 ahead. Slide 29 looks at calendar year returns. So breaking this down further, notably on the far left, we have just the year to date. Through June, year to date return for the total fund is still negative, down about 3.7%, including July, where we saw about a 3.6% return for the program. The total bottom dot. And then the same is true on 30 and 31, looking at fiscal years in particular. So from looking at each of the last 10 fiscal years, the total plan has been in the top quartile of the peer group 5 times, 5 of the 10 calendar years, the bottom 3 times, and about in the middle twice. Now, notably, the target performance is in the top half of the peer group for every fiscal year that we look at here. Active management has benefited in some fiscal years and detracted in others. And of course, the work that we're gonna look at specific to the domestic equity portfolio with Jay will address that more specifically for that asset category. Cumulative returns on slide 32. So this just looked at cumulative return for the total program over the last 15 years. And the blue line is your investment program. The green line is the target. The takeaway here is that over the last 15 years, the active implementation of the portfolio has benefited over that time frame. So, you know, if you started with $100 million 15 years ago, you'd have about $20 million more than you would have implementing with just index funds. So active management has benefited and detracted on various quarters and fiscal years, but over that longer term time period, the implementation has benefited the program. And then 33 looks at the relationship between risk and return. So this is nothing new for you all. The total program has achieved over the last 15 years a higher return than the strategic target, but by taking on a bit more risk as measured by standard deviation. And then on slide 34, we look at attribution. So I mentioned that in the last quarter, every asset category, the implementation of every asset category contributed to outperformance versus the target. And that's really highlighted on the top chart and in that green box, the manager effect. So implementation of each asset category added an aggregate 2.5% to the total return versus the target. Asset allocation effect, so that's any friction between, you know, the exact strategic target and where actual returns were, detracted slightly. That's consistent with expectations. But in aggregate, the actual return was again about 15.87%, and the target was at 13.57. So manager effect driving outperformance in the quarter. Now, over the longer time period, the last 5 years, public equity remains the most challenged implementation over that longer time period. And again, we'll talk more about that with Jay Klepper in a minute. But you can see that domestic equity and international equity implementation there has detracted. Real estate and fixed income have benefited returns versus the target again. And then lastly, we've got performance detail for all of your individual managers on slides 35 and 36. 35 in particular, looking at domestic equity. Again, Jay's about to get into a lot more detail here, but I think the most striking things here are the magnitude of the second quarter results for your equity managers. So you can see for the recent quarter, every domestic equity manager in your portfolio was up double digits, ranging from 16.4% for Boston Partners, your large cap value manager, to a positive 37% gain for AB, your small cap growth manager. For the fiscal year, that last 1 year time period, the growth managers have turned in positive gains over the last year, the value managers have turned in negative gains on an absolute basis. And that's consistent with what Greg pointed out in terms of trends we've seen within the broad market. Growth continues to dominate. Value has trailed, specifically in the last year. And then also consistent with Greg's comments, you can see that the mid-cap and small-cap managers have trailed your large-cap managers in absolute terms over longer time periods. And that's consistent with what we've seen in the broad market. International equity managers and fixed income and real estate captured on slide 36. This was a particularly good quarter for the international equity composite. It was up about over 20% versus a 16% return for the benchmark. This category has been the most challenged for your program over a longer time period. So we're pleased to see a good quarter. And of course, this is the asset category that we'll be focused on from an implementation perspective at our next quarterly meeting. The fixed income and real estate managers, those asset categories overall continue to be quite steady for this program. In aggregate, they've outperformed their benchmarks over all time periods shown here. Dodge & Cox and PIMCO continuing to be good complements to each other, and the core open-end real estate managers turning in pretty steady gains with the exception of the last quarter, and Greg mentioned some of the comments there. So income now, a larger portion of both of those managers returns over appreciation, which had been the reverse for the last few years. So the total fund at the bottom again, just about a 16% return for the quarter, about 3% gain for the fiscal year, and over longer time periods, over an 8% gain annualized for the last 10 years. Are there any questions on performance for the program for the quarter or the fiscal year before we move on to the discussion of the domestic equity structure review? The last few slides here, as Greg flipped through, those were just looking at each asset category versus peers. Again, the domestic equity and international equity composites had a great quarter versus other peers' implementation of those asset categories. Real estate and fixed income positive, generally steady over longer time periods.
Okay, are there any questions before we hand it over to Jay?
I have one question.
Okay.
So earlier you talked about the concerns over the slow progress of dealing with COVID compared to other countries, and that might affect the value of the US dollar. So how do you see that affecting life in America and the fund? I mean, do you see it the possibility that the US dollar will go down in value compared to other currencies? And if that's the case, you know, presumably, I guess that would lead to higher import prices. And also, I don't know, would it also lead to higher interest rates? I'm just kind of curious, what's the scenario there that you see?
This is Jay. I'll take a quick shot at it if you don't mind, Greg, and you can add. Is that right?
No,
Sure.
have at it. You're the economist.
Your concern is being expressed by many in our industry as they're scratching their head. As Greg showed, inflation actually turned negative, but the really big concern is with all this stimulus, both here and abroad, that inflation could actually take off, and that in the U.S. in particular, both due to our different performance when it comes to handling the pandemic, as well as just how much we have put into trying to stimulate, that the dollar, the value is under pressure. The value of the dollar is under pressure. And yes, so that would raise import prices. It would improve your non-US investment, right? Because you'd be getting remitted in the foreign currency that's gone up in value. And it would put inflation pressure on. Whether it would actually pressure rising rates yet, that's a little harder to decipher. The Fed has actually come out and said, in no uncertain terms, not only are we not thinking about raising rates, we're not thinking about raising rates for 2 years. So 2022. And then the Fed also has their target for the federal funds rate in the longer term, which is, you know, how long the go away that is, of about 2.5%. But you go 0, 0, 0, then up to 2.5%. It's going to be quite a while till we see rates rise. They could rise in response to inflation, however. So you got your finger on one of the important points. I think the irony is inflation has evaporated, but the risk of it has risen. And the downward pressure on the dollar is real. And that's why you're seeing so much interest in things like non-dollar investments in particular. By that, I don't mean non-US, I mean non-dollar denominated. So gold has become popular amongst at least retail investors. To us, gold is not an economic investment. It's a bet on a price play. And I'm not quite sure I'd be willing to make that assumption that's really a bet against all currencies, not just the dollar. Because the other element in this, sorry, this is a long answer, but I find this interesting. If you say the dollar is going to go down, what's it going to go down against? The euro, the yen, the Chinese renminbi. You want to bet on them? I would, if you put it in those terms, it makes it a little less appealing that could actually happen. So to me, a bet on a dollar is a move away from paper currency, which seems like a fairly remote but plausible alternative.
That help, Dan?
Yeah, it's interesting. I'm just kind of curious. We have members who have mortgages. I'm just curious. I mean, these sort of record low mortgage rates right now, it sounds like now's the time to lock in.
We could go negative too. There's, you know, we have stated a policy that we don't want to go negative, but the market could overwhelm policy. That would not be a good outcome.
Yeah, but Dan, to your point, the refi activity has been really significant, and a lot of people are taking advantage of the lower rates now. I think there was the first wave of refi, then it kind of got through the system, and now rates come down a little bit more. That can come, you know, so we'll probably see another wave of refis.
Thanks.
Yep,
Okay.
I'm in the process.
Oh, good luck.
Yeah. All right, Jay.
Okay.
Let's talk domestic equity.
Sure. Do you have anything you want to say to kick us off, Greg, or do you want me to launch in?
Well, yeah, I kind of teed it up a little bit at the beginning. So keep in mind, we did the AL study, and now we're going through and looking at each asset class. And Claire alluded to this in her comments that a lot of times we're either first or worst in peer ranking, and that's because we have a very big equity tilt, U.S. stock market, international stock market tilt, relative to other plans. And historically, we've acknowledged it, we've measured it, we accept it, and it works in the long run, but it can be a bumpy ride along the way. So we have asked the question, should we increase diversifiers? We looked at a bunch, we decided to put in a little bit of infrastructure. That's in process, takes some time. And now when we're looking at the domestic equity structure today, we're asking a few questions. One, do we like the balance of active versus passive? And then two, are there other types of equity and strategies we can invest in that might lower the volatility of the plan in aggregate? So those are really kind of the two key questions we're asking. In the grand scheme of things, what you're doing right now is fine. It's appropriate. It should work in the long run. But we do have a couple tilts in the portfolio that we want to bring to your attention. Blend of active management, small cap orientation, long equity beta. And then after looking at those tilts, we're going to show you a few different scenarios where we might be able to rein in some of those tilts a little bit. So that's a bit of the intro.
Okay, great. Thank you, Greg. We have the agenda laid out on slide 42. Greg's pretty much summarized it. So slide 43, just a couple of quick summary points. You already know this stuff, but there's your current allocation. A couple of things I want to point out broadly. 38% target to U.S. equity, so it's $205 million. This is as of June. 57%, U.S. equity is 50% of the total public fund equity. How does that compare to the benchmark? It's pretty close. If you look at the ACWI IMI, which is the All Country World Index, All Country World Index, IMI Investable Market Index, that includes smaller cap. It's 54, so you're roughly in line with the benchmark. The U.S. equity allocation is benchmarked to the Russell 3, but you do include separate allocations to large and then mid and small. So in that regard, there's your the starting point for looking at this. And so when we look at equity, what's its role in the portfolio? Well, it's a big allocation. It's 57, it's what do we got there? 30, 40, 50, 67% of your portfolio. 2/3 of your portfolio is public market equity. It's a big position. And so to reiterate what Claire and Greg have said, that's the driver of your return and the reason why your performance moves around from top to bottom. If you go to the next slide, there's a lot of information on this slide, but let me put it in some decent context. So 2/3 of the portfolio is managed actively, 2/3 of the equity portfolio, and the other third is managed passively. So you've paired up growth and value in the large cap, the mid cap, and the small cap space. And then you have two index funds. One is a standard S&P 500, and the other is what's referred to as an equal weighted index. And very quickly, the difference between the two, an equal weight gives us essentially $1 to every stock in the S&P 500 to add up to $500. Whereas the Vanguard S&P 500 weights it by the market capitalization of the underlying components. So as Greg suggested, those 5 stocks or 7 stocks making up 20% of the market cap, you have that in the S&P 500 index fund. The cap size, you have 70% allocated in dollar terms to large cap, 15 to mid, 15 to small cap. How does that compare to the index? On the Russell 3000, there's a little bit of a squishiness with regard to measuring cap because typically, and you benchmark your large cap managers to the S&P 500, whereas that's not part of the Russell family. So you kind of have to carve it out of the Russell. They have as the Russell 1000, but embedded in the 1000 is both mid cap and large cap. So it can be a little confusing, but let's think about this broadly. We think of the Russell 3000 as about 80% large cap as thought of by the S&P and about 20% mid and small. So you have a bit of a small cap overweight just from the dollar allocations. And we're okay with that. I mean, we expect small cap to do better over the longer term. It's certainly been challenged. And then with regard to style, the dollar allocations are even, so 35% in core, which means there's not a tilt to growth or value, and then 25% in growth and 25% in value. Now, what's been amplifying the small cap bet in your portfolio is implementation. So Boston Partners and Harbor Capital are pretty large, but that equal weight portfolio is much smaller capitalization than the S&P 500 because you've taken all 500 stocks and given them $1, as opposed to overweight, or not overweight, weighting in line with what the market cap is of Apple and Google and Netflix and Facebook. So it's bringing down the market cap a lot that you don't see just by looking at the dollar allocations. So we'll go through that as we go through the analysis. So, and then the final thing, there's 8 managers for $205 million. It's not excessive. We actually trimmed it the last time we went through this process. We also have clients that could have as little as 1 or 2 for that amount of money, depending on how you choose to implement. So there's quite a range there. I mean, right now, the idea of being paired growth and value in the 3 cap ranges make fine with us. We like the idea of growth of both active and passive, and we'll talk about that. So if we go to the next slide, please. I'm going to give away the story up front here so we can keep thinking of it as we go through the discussion. So why did we look at this? Do we think there's anything wrong? First of all, I don't think there's anything wrong necessarily. As Greg said, it's efficient. or looks reasonably efficient. 8 managers is quite a number, but 2 of them are passive, so they're inexpensive, and then they're paired, growth and value. The smaller cap bias, again, coming from 2 sources: a dollar allocation, which doesn't bother us tremendously, and then the implementation, which will show you how that shows up. And so what we thought of were a couple of ideas. One is, let's reduce that small cap bias, or what does it mean to reduce it? 2, focus active management where there's the greatest conviction. And to give away some of the story up front, we tend to have greater conviction in smaller cap than we do in larger cap. And 3, given that public equity is 2/3 of the portfolio and the US equity is almost 60% of that, is there another strategy you could put in that would help dampen volatility? So we looked at a strategy that's gaining popularity in the institutional space called low volatility, and see whether or not that's a meaningful allocation one could make to this portfolio. So the alternatives are outlined here, 1 through 4. So the first just simply takes out the equal weight mandate. We'll talk about that in a moment, and it reallocates it back to the general S&P 500 index. And that will reduce the small cap index pretty substantially right there. Number 2 would be to get rid of the equal weight index and then reallocate both of the large cap active managers to the S&P 500. And that then focuses your active management in mid and small cap. That would likely be the least expensive option as well. So it reduces the small cap bias, focuses the active management, and it will reduce the cost the most. Alternative 3 eliminates the equal weight mandate and introduces low volatility in its place. So low volatility, we'll talk more about it in detail, but it would be largely a passive exposure or semi-passive exposure. There's modeling involved by the managers that will diversify the large cap. It will raise the market cap. These tend to be pretty large cap mandates, and provide some risk reduction in down markets. So the objective, it's going to reduce the small cap bias by eliminating the equal weight, and then consider adding this diversifier. And then number 4 eliminates the equal weight mandate, also takes out the active large cap and introduces low volatility, but even in a little bit larger amount to really have a bigger impact. So the one way to think about this that might be helpful is alternative 1 takes out equal weight, alternative 2 takes out the equal weight and the active large cap managers, and then as a pair to those, alternative 3 replaces the equal weight with low vol. Alternative 4 replaces the equal weight with replaces the equal weight with low vol and gets rid of the active large and small. So 1 and 3 and 2 and 4 are kind of like paired alternatives. I realize this is a lot of words and a lot of talking. Hopefully I have a couple of charts here that'll help it make a little more sense. As backdrop, I just want to give you some idea of how we're thinking about these notions. One of the big factor expressions you have in your portfolio is the small cap exposure. These are just comparisons of returns over calendar years and cumulative returns. It's been tough sledding for small cap over the last 15 years. So the far right, the blue bar, shows that it's underperformed the top 200, which is the large cap and the mid cap index, over a 15-year basis. Individual years have done okay. They're on the left. So 2013, 2016, small cap did quite well, and we thought perhaps it was turning around. But it's been a challenge. And if you look at the next slide, this is the cumulative return relative to the Russell 1000 on the top, and then the actual rolling 4-year excess return relative to the Russell 1000. So the lower chart looks like, well, it has periods where it does well, then periods where it doesn't. But cumulatively, it's been tough sledding if you went all the way back to 1996 or 97. It's just been, it's very interesting because in theory, one would totally expect smaller companies have more room to grow quickly. And what's been happening, I think there's a variety of different reasons why, but we still believe in theory and in long-term practice, small cap is a place to do well. I think part of it is the indexes are a challenge. The Russell 2000 has often been characterized as a couple of hundred really good companies and 1,500 really terrible ones. So it really matters to have active management in that space to try to do better than what the index depicts. But so long story short, it's been a challenging period over history. We still believe in small cap as a vital part of the portfolio. With regards to style, the other area of pain for many investors, value has had a really tough sledding along with small cap and in similar periods. So you look on the left, 2013 almost matched, 2014, 2016, value is the blue bar. But over these longer periods, it's really had a tough time keeping up with growth. And that's been both concentration, and in particular concentration in technology has been part of it. Just a market that seems to really value fast growing, almost revenue, companies that don't even have revenue at times. And it's been rewarded. But again, we think value can play a role. It's typically less volatile. Really good value managers can be additive to the portfolio. It's just been really painful to hang on over this period. I mean, this chart gives you an idea of these periods where growth outperforms is the green, and it's been concentrated in the last 10 years in particular. So the basic tenets of manager structure, if you go to the next slide, please. So how do we go about thinking about this? Structure is implementation. You've decided a certain percentage in U.S. equity. How are you going to put it together? So it's going to reflect, what's the role? Well, it's growth. It's capital growth over the long term. Our starting place is what's the opportunity set? So we want to be neutral to that opportunity set, neutral to the broad market, both with style and capitalization, unless you have a really strong desire to tilt it and it's compelling to you. We like having full exposures to small cap as well as emerging markets. So, the whole opportunity set. And we really think you really have to sort of believe and articulate your desire to be different from the broad market to put in tilts. We're not opposed to them, just make sure you own them because there will be periods where they're out of favor. We want to make sure there's enough managers to cover the market and really take advantage of their skills. But a whole bunch of managers with little tiny allocations often doesn't do much other than make the portfolio more complicated and more expensive. We like active management. We like passive management. We just think we ought to be judicious as to how we use them. We typically focus our passive management in large cap efficient markets. It helps reduce cost. It's a very cheap, diversified portfolio. And then really focus active management in areas where you think the active manager can do well. So not only in equity, but in fixed income, for instance. And then finally, implementation. You've got a plan that has evolved to where it is now, and just rearranging everything and putting in a lot of disruptive change for minor benefit is something we want to be aware of and make sure we're not, indulging in such behavior. On the active versus passive side, I know this is a common discussion point. Let's define what passive is and active. I'm on page 51, Greg. Passive, you're just simply matching the benchmark. And in equity, it's a pretty easy and cheap way to go about putting it together. I say easy, I'm not doing it, but for the investment managers, it's easy. It's typically, you pick an index and you're going to match how it performs, okay? Active management has been a challenge, trying to separate out where are you getting active management? Is it a factor tilt? Is it security selection? That's a lot of the work that we do when we do performance. And there's a lot of art form to being able to pick an active manager that can systematically outperform after expenses. The benefit to passive management is predictable results relative to the market, but there's no opportunity for alpha. The low fees, and there's very few administrative concerns. And then over the long run, you do have to be aware that fees and trading costs will actually eat a little bit into the passive. You won't exactly get what the passive index suggests. So as we go about picking, as we go about thinking this through, we do believe in active management. There's a list of our issues here. I'm sure Greg and Claire have taken you through most of them, but how many are there? What's their level and consistency of skill? Can you identify them? Can you hang on to them through periods of underperformance? And then passive management, again, the biggest point for me for passive is pick your spots and then understand it's a continuum. It's not an all or nothing choice. So you can pair active and passive together. We think that makes a lot of sense. What do you have to do to generate a return that's going to pay for active management? You can see in large cap, for instance, this is the charts that we update every quarter. That second one down, large cap core, the average excess return over, on a rolling 20-year basis is positive, but it's only 19 basis points. So it's pretty hard to beat that net of fees. And you can see, a better historical result anyway for smaller cap stocks. All right. So that's sort of the introduction education part of the show here. Let's look at the overall structure. We've already spoken to everything that's on page 54. 3 growth, 3 value managers, 8 managers total, 35% passive, 65% active. And then we've spoken through what the questions are. So we'll look at the cap weight strategy, and we'll look at the different components. You just saw this chart. This to me is a great illustration of how much beta is within your beta. So beta, think about it, is just how much do you move when the market moves. And it's also referred to as how much exposure do you have to the market. So in an asset allocation sense, how much exposure do you have to the Russell 3? And then here, how much do you move like the Russell 3? And so your portfolio is long Russell 3 beta, and you have a lot of it in the total portfolio. So, at the top or at the bottom, depending on how the market's doing. So it's something to keep in mind. The next slide is where we take a look at, well, how does your plan map out? And let me explain this because it's a pretty useful chart. Along the left axis is exposure to capitalization. So small cap down below, large and mega cap up above. Mid is in the middle. It doesn't mean that's where you need to be. It's just the midpoint of the capitalization range. And then across the y-axis is value, core, and growth. So the Russell 1000 growth is obviously a very large cap and far to the right on the growth schedule. So the Russell 3 is your index. Where does your portfolio map out? So the red triangle or diamond is the historical 5-year calculation of exposures to capitalization and style. And this is done against the holdings of the portfolio. So very interesting. Your portfolio has a substantial small cap bias relative to the Russell 3. A little tiny bit of a growth bias, and that comes through from the active manager performance. If you turn to the next slide, a little busier, what we've done here is add in the managers. And what those circles mean is there's a bunch of plots because we do this calculation on a rolling 3-year basis over 5 years. And it puts a bunch of plots or little dots, hard to read. So we draw a circle that captures about 80% of all the little dots for each manager. So you can see that, pardon me, the portfolio now has a pretty broad range where it's moved around. But let's highlight a couple things. One, that red sliver there, that's your equal weight index. So much smaller cap than the Russell 3000 and a valuation tilt. The rest of your managers plot where we would kind of expect them to be. So Fidelity low price stock is not an extreme value manager, and it's certainly in the mid cap space. Janus growth in the mid cap space. Harbor, very growthy, very large. And then Boston Partners with a little smaller cap and a value orientation. And then you can see the 2 small cap managers. So the sum of all those give you a much smaller cap than the Russell 3 and a bit of a growth tilt. So we find that to be a very useful diagnostic. What does that mean for performance? There's 2 ways we've looked at it. The red line is your historical performance given all the changes that have gone on over the last 10 years. So it's reflecting that you've hired and fired managers and you've changed allocations. The blue line is if we took your current portfolio and backcast it or created a pro forma track record. It just held the weights constant and did it over time. And so, and then the top chart shows the relative return compared to the Russell 3. So there's been periods where it's done better than the Russell 3 and periods where it hasn't done as well as the Russell 3. But it's been pretty volatile up and down. And then the tracking error is essentially the volatility of the excess return. So the big drop there in tracking error in the red line was change you made. This is a rolling 3-year number, was changes you made to the portfolio in the past. That spike in tracking error in the first 2 quarters is simply the effect of the pandemic with the giant drop and the massive recovery, the V-shaped recovery in the bottom. So what the bottom chart shows is that the tracking error had been higher until about 3 years ago, and then brought it in with some of the changes we made 3 years ago to the portfolio. So tracking over 2%, and if you take the current portfolio and show it over history, it's more like between 1 and 2%. So again, you need tracking error to get active management premium. So the principles on the discussion, I think I've really covered this already. Looking for unintended biases, so we've already spoken what those are. Overriding philosophy, it's simple, straightforward. So the proposed mixes. We've talked about these, I introduced these already, I'll just reiterate. Number one, reallocate the equal weight to the S&P 500. Why? Help reduce the cap bias, reduce the misfit risk, so it looks more like the index, and reduce the tracking error. Alternative two, get rid of the equal weight and get rid of the active large cap and reallocate all of that to the S&P 500. So really focus active management in the mid and the small cap. Alternative three looks like one, but instead of putting it into the S&P 500, introduce low volatility as a diversifier. And alternative four looks like two, but instead of putting it all in the S&P 500, introduce low volatility, but in a slightly larger amount. Okay. So first, let's take a moment to talk about defensive equity. What is defensive equity? There's a variety of approaches that use similar language. So there's low volatility, there's low beta, there's minimum volatility. Essentially what they're doing is sifting through the stock universe to find lower volatility stocks. And the notion is that historically individuals have overpaid for volatile stocks with the promise of a higher return that hasn't quite shown up. So it's a bit of an arbitrage opportunity. And so the flip side to that is lower volatility stocks have been sit a little bit unloved, but the return has actually been good, especially when you do it on a risk adjusted basis. And so what you're really looking to do is overweight individual stocks with a lower volatility. So defensive equity indexes that try to track it come up with a proxy that tries to match what these approaches are. They're not perfect. There's often constraints. They're very model driven. They tend to be priced somewhere between really active and passive. And one of the best indexes to try to get a handle on this is something called the MSCA Minimum Volatility Index. And there are constraints put on it so it doesn't go too crazy in one direction or another with regard to sectors or risk exposures, factor exposures. So it's sort of a more enhanced version of enhanced indexing in some sense. And we find these used in a couple of places. So one is a traditional long-only investor who really doesn't want to or can't use leverage. Well, you know, I don't know, this bottom quote here, I'm not sure if I really like the way I've put this out here now that I look at it, but where I've seen this used is in a couple places. Someone with a very large equity exposure who needs to have the equity exposure, it's perhaps a way to tame downside volatility. Second, those who have very small equity exposures don't want it to be the tail that wags the dog when there's only a little bit left in the portfolio. So those are two uses we've seen applied. So let's take a look now at how these might apply. So here's sort of my description here on this page of why they might have some meaning for you. So first, how do they work, or what have they done? Look on page 63, and the red bars or the rust colored bars is the MinVol index. So in every drawdown, so this is a listing of, we have we have a software system that allows us to pick drawdown periods. So when there's declining equity periods, then how did the Russell 1000 do? And then how did the MinVol index do? And in every single case, it did better. It had less loss. So it's implying, you know, as the name implies, you may experience a smaller drawdown. So what does that mean though in better times? Well, you expect it not to do quite as well in really good times. So you're trading off a little bit of upside for less worse downside. Okay. So that's sort of the argument about, well, if we're going to keep a large fixed or equity allocation and is there something we can do within the portfolio to perhaps limit risk short of more active managers? And here's one particular option. So if you look on page 64, a bit of an eye chart again, but trying to walk you through the alternatives. So I've described them in words. Alternative 1 starts with the current target. So you can see these are the target weights, not the actual weights, but the target weights. So 15% in small cap, split between growth and value. 15% in mid cap, split growth and value. And then the 70% in large cap, split, half of it passive, half of it active, and then the active split. Okay, so alternative 1 moves that equal weight into the the S&P 500. Alternative 2 moves all of large cap into the S&P 500. We did not adjust the mid and small cap weights. We're comfortable with those. Alternative 3 moves the S&P 5, the equal weight into this candidate low volatility. And alternative 4 looks like alternative 2, but splits about 60-40 or maybe 2/3, 1/3, the S&P 500 and the low volatility. And the idea being putting even bigger position in low vol to see if it has a bigger impact. You can then see what it does to the total number of managers. Alternative 2 reduces it the most, takes it down to 5. Alternative 3 keeps the number at 8. The next page gets at what does it do to fees. So I'm on page 65. As I suggested up front, alternative 2, which moves all of large cap into passive, reduces the fees the most. Alternative 3, which introduces low volatility, is actually a little more expensive because we expect a low vol index like exposure to be more expensive than the equal weight index that it's replacing. And there you can see my assumption of 25 basis points. So what is this? How does this now look? Does it solve any of the issues we were trying to get at? This is on page 66. We're now go back to our style map. So you can see how, again, the historical analysis for MSARA's portfolio, very broad. That again includes multiple different managers in there, so it's going to be bigger than the others. But you can actually see the pairing. So alternative 1 and alternative 3 are close to one another, and alternative 2 and 4. So alternative 1 again takes out the equal weight index, puts it in the S&P 500. So it's definitely raising the market cap for the portfolio. Think of the midpoint of those circles. Alternative 3 is a little bit lower. It puts it into the MinVol index as opposed to the S&P 500. But it retains a little bit of that growth orientation because we haven't adjusted the active managers. And then alternative 2 takes out the large cap growth and value managers as well as the equal weight. And now it's lining right up on top of the Russell 3000, which to me makes logical sense. That's where I expect it to land, given that now 70% of the portfolio is indexed. And then alternative 4 includes some of the min volatility as part of large cap, lowers the cap just a little bit. So I guess taking out the equal weight index does address the problem, in our opinion, of the smaller cap bias. And then whether or not to keep both active managers is really the difference between 1 and 2. And whether to add the minimum volatility index is really looking at those pairings between 1 and 3 and between 2 and 4. We have a little bit more analysis to take you through just to think through that. What does it mean for performance? If you look on page 67, this is that relative return performance we spoke of earlier. I realize it's a bit of an eye chart. That's my favorite term today. But you can see the current target. This is the rolling 12-quarter return relative to the Russell 3, which is your planned benchmark. So the dark green, is it black? Sorry, my eye color is not very good. The bottom bar that says target, you can see is typically near the bottom of the performance compared to the alternatives. And then you can see how 1, 2, 3, and 4 stack up. So alternative 1, which takes out the equal weight, at least over the last couple of years, is near the top of the pack. All of them appear to do a better job in terms of excess return relative to the current target. And again, that's a lower small cap. That's just simply a result of having less small cap. the tracking error, all of them reduce tracking error relative to the Russell 3 as well. Alternative 1 does the least amount of tracking error reduction because it's keeping in all the active management. And then also looking at the performance then on page 68, this is a cumulative relative return. To me, what I was trying to get at with this was alternative 3 and 4 are the two alternatives that include the minimum volatility index, and how have they done over, at least over the history. And interesting to me, so the top chart is return relative to the target. So if you made a change from the target, how would this have done? And then the bottom chart is, well, let's compare them all relative to the index, the Russell 3000. So first of all, look at the red line there. That's the Russell 3000 relative to the current. It actually did better over the last year and a half just because of the small cap weighting. But I was surprised to see that both 3 and 4, which include the min vol, did better. So in a period where the equity market was doing really well, they actually did better than I thought they would. Because you would expect them maybe not to quite keep up. And it also shows through in the bottom chart relative to the Russell 3. I mean, up until the start of this year, they actually did better than the Russell 3. Those mixes that included the min vol. One more chart of data on page 69 is looking at there's absolute standard deviation. It's really hard to discern the differences, but I thought it's worthwhile to see, does it actually reduce risk, overall risk? And interestingly, the current target has a higher risk than the Russell 3. Again, that's the impact of a bit of the growth tilt and especially the smaller cap. And then as you get to alternative 3 and 4, you get a lower volatility. And then relative standard deviation is the bottom chart. So what we're trying to do there is say, well, if you have the current target, what was the volatility relative to that? And you can see that, alternative 4 in particular, that has the bigger allocation to minimum volatility, could meaningfully reduce, well, it could reduce volatility by about 10%. But so could alternative 3 is then the next one up. Even alternative 2 would reduce that relative volatility. So how do we wrap all this up? If we go back, Greg, we should probably go back to the chart that has the allocations, which I think is 64. So how do we think this through? Well, one, the equal weight index, we're not sure we see a good role for it in the portfolio. It definitely lowers the market cap. It adds a lot of tracking error. And in our opinion, if you're going to want it to have more small cap, maybe you do that explicitly. And we like, relatively speaking, the 70, 15, 15 allocation in dollar terms. So our suggestion is removing it in all 4 of the alternatives. 2, to the extent you're comfortable or not comfortable with pursuing active management in large cap, there's 2 alternatives there. So alternative 1 retains the active management in large cap, alternative 2 takes it out. And then to the extent we wish to consider the minimum volatility, alternative 3 replaces the equal weight with it, and alternative 4 puts an even bigger position. And I guess the question is, we were discussing this internally, is, do we believe there's a compelling argument for minimum volatility? What would we think it'll do for us? To me, the answer would, there's still some judgment here, but you would expect it to provide downside protection in a market drawdown. You would expect it to not quite do as well as passive in an up market, even though the experience of the last couple of years showed that it actually did pretty well. So Greg, I don't know if you have other comments to help tie this up for me here.
Sure, yeah, thanks for that, Jay. So maybe we'll try to get any impressions from the group. And so as Jay mentioned, there are a couple of decision points. One, do you agree in the need to reduce the small cap overweight, which is coming from the S&P equal weighted index? 2, how much active versus passive do we want in large cap? So we have alternatives here which either keep passive roughly the same or get rid of the business of active management in large cap. And then 3 is their interest in the concept of the min-vol or low-vol equity. So those are the 3 decisions we have here. So maybe I'll open it up to the group and see if there are any thoughts at this point.
Well, it seems to be your recommendation, or at least I think you're recommending to scale back, maybe eliminate the active management in the large caps, is consistent with some of the other things we've discussed at other meetings about, that there's really no secrets about the big companies. I mean, pretty much there are lots of journalists, lots of analysis going into the large companies. Presumably the market value is fairly accurate, and there's not some great value in picking one of the S&P 500 stocks over the others. So it seems to me that there's not probably a lot of value in paying for active management in large stocks, but the greater value probably comes in the smaller stocks. And anyway, so that's just, I tend to lean in that direction to eliminate the active management in the large stocks.
And I tend to lean in looking at that a bit out of shape as far as looking at the small stocks. We have a bit too much, and if we're trying to do a better job on risk management, I might favor more large stocks. Also, with COVID and the direction that so many companies will have to go, I think we're going to lose a lot of small companies. But that's just an amateur's observation. So.
I tend to agree with everything that's been said so far, and that with the uncertainties that we have for the next year or two or more, active management in the mid and small cap stocks seems to be, we want to have somebody with their hand on the steering wheel.
Yeah, I agree with that one.
Okay. So any other comments on the split between active and passive?
Greg, this is your area, or you and Jay and Claire, this is your area of expertise. So if you were on this board, what do you think you would recommend?
So we did have a pre-call with staff, and I tipped my hand to them. And I think I'm in alignment with you, where I think moving to passive large cap, market cap weighted makes sense. So alternative 2. I have been a little bit on the fence about whether or not I believe low vol equity anomaly will persist in the future. So we've seen it persist in the past. It's rearward looking. Do we think it will persist in the future? And I haven't been convinced of that yet. So for that reason, so if we move from active large cap to passive, that leaves alternatives 2 or 4.
Mm-hmm.
And then when it comes down to 2 or 4, it's, do I believe in low vol equity going forward? And I'm not fully convinced that the past will repeat itself in that regard.
So 2.
So part of the reason some low vol equity performed well is it looks for certain companies that and these indices are all constructed a little differently, but they might be higher dividend yielding, lower debt, things, you know, the dividend point in particular do well when interest rates come down. And so that there have been certain factors that have been a tailwind for low vol equity. And I don't know if I believe that they'll persist going forward. So for all of that, to me, very fast, I would lean towards alt 2.
Yeah. Thank you. Don't jump in with both feet, guys.
Well, I would just ask, aren't we putting a lot of eggs in one basket? By alternate number 2?
Right, so putting everything in the S&P 500?
Right.
Yeah, everything is already in the S&P 500.
Mm-hmm.
But we're putting it all in one manager, right?
One strategy, correct. But I mean, everything that Harbor and Boston Partners invest in is in the S&P 500, just in different weights. So, but yes, you're right. You are putting all your eggs in the passive basket. So to the extent enough anomalies pop up that could be taken advantage of through research in large cap over the next 1, 3, 5 years, you give up that opportunity.
Yeah, but if part of your question, M, is are we worried about the Vanguard S&P 500 index fund performing as we would hope it would, and that we want it to match S&P 500. We don't think there's manager concentration risk for you or you know, fund manager risk for you there. But it is a move to say, you know what, I don't want active management in large cap, and then you know, 70% of the domestic equity portfolio would be in the S&P 500. So what the target's 39, right? So it's 70% of the 39% would be in the Vanguard S&P 500 fund.
I'm more of the belief with Dan that it doesn't seem like the active management and the large caps has benefited us as much as it's cost us.
Yeah.
And options 1 and 3 seem to be very aligned with the target we're at now for the fees, and 2 and 4 are significantly reduced. I do understand what Tim is advising about, you know, all the eggs in one basket, but they're the same companies, just different weightings. So.
Come on, Lee, it's your last chance to weigh in.
Well, I remember one of the PhDs at Berkeley. I managed to stay awake through a couple of hours talking about this, and the takeaway was that just what Quincy said, that management in large cap is not really cost effective.
Yeah.
I would like to say, just to point out that the SSGA Equal Weight Fund is relatively inexpensive. That cannot necessarily be said for Harbor Cap or Boston. I think we pay maybe $18,000 a year for SSGA in terms of management fees. So it's very small fee. But I think the bigger issue is kind of shifting the focus away from small and cap buy.
Yeah, the argument for an equal weighted index, it comes and goes in vogue, if you will. Typically when the markets concentrate, which you could argue they're very concentrated right now, it's a deconcentration play. But if you deconcentrate, you're intentionally not holding the 20% position of those top 5 stocks. And you can be wrong for a long period of time. But you will not then suffer the slings and arrows of a fallout from that concentration, which we saw, in the 70s, for instance. And then we saw after the dot-com bubble burst in 2000 through 2002. So in both of those times, deconcentrated index helped a lot. And in fact, there are people that take it much further. I mean, this is like, an equal weighted index is like the dumbest of the smart beta portfolios. Or it's a smart beta portfolio, but it's not as smart as its cousins. I don't know how that's the right way to put it, but that focus on factors. And there are deconcentration factor-based portfolios that can make your head swim. But the idea is that if you're really worried about, what Greg spoke of, that 5 stocks are running the world, and you want some exposure to a portfolio where 5 stocks aren't running the world, this is one way to do it. You just have to be prepared for a really large tracking error and underperformance while those concentrated portfolios run.
Yeah, and on top of that, I think our point about the equal weighted versus small cap is, even if you go to the S&P 500, we think you're going to have a little bit more small cap exposure because you have 30% of your dollars allocated to small and mid cap managers. And what it is now is that tilt is in the portfolio twice by having active managers in small and mid cap, maybe in 3 times, having more dollars in small and mid cap, and then also having the equal weighted index. So you're expressing that view 3 times, and let's just express it twice. So that's why we're more, but I think there is a question of timing.
Right.
If there's consensus that all 2 makes sense, what we could do is move 5% of the portfolio every month or 2. They're all funds. You just move 5%. You put it in the S&P 500 every couple months and leg into it, if you will.
It makes me a little more comfortable.
Greg, I was looking at one of our performance. We've only been in that fund less than a year or a year. And what has changed in the year?
Everything.
We only have returned for 1 year with them.
Well, I think that just happens to be a page where we don't show the full inception date. But the equal weighted index was added the last time we did a structure study. And following that study, the decision was made to go into this equal weighted index. And since that time, there are different people sitting around the table right now. So I think that's the change.
Well, I'm just looking at the return, and there's nothing for the last 3 years. The only last year, so I think we would have it as 2 years. But and then the other more general question: when people sit around scratching their head and say, "How is the market, U.S. market, doing so well in this time when our economy is doing so poorly? Is this a good time to be looking at something like this?"
Part of the move to passive and large cap is the belief that you can't make that call.
Yeah.
That we don't know. We don't know how the environment today is going to impact the 500 largest companies in the United States. And that no one can know that, and no one can express that view consistently net of fees over time. So that's part of the philosophy there, Tim.
Well, there's a time to run on autopilot and there's a time not to, and in clear sky, autopilot's great, but going into flying in the clouds and autopilot is another story. We're in a lot of clouds right now, and I think, again, we should have our hand on the tiller.
This is Sherry. So what I'm hearing really is you guys are you really concerned about, I mean, we've often been at the top and the bottom, but are you really worried our bottom could be really bad if we don't make some changes here?
I think the levers to keep you from the top or the bottom in a peer ranking, the most powerful levers there is in the asset liability study, where we decide how much money we want in stocks overall, bonds overall, real estate infrastructure, other diversifying strategies. So that is the big lever. That's how we really control that. And we went through that study, made the decision, we want this much money in stocks. The changes we make within the stock portfolio, they're little tweaks. They're not going to really change your overall risk posture. They will a little bit. So Jay showed a chart that said one mix here will have a volatility of 23, the other will have a volatility of 22. In the grand scheme of things, if we're on the wrong side of that volatility, it's going to feel quite the same to us.
Greg, this is Jeff. Can I interrupt and ask a question? So when was that risk study done? The last time the board looked at that?
The asset liability study?
Yes.
It was done last year.
So I don't know when that comes up for review, but given the COVID, and I usually don't talk much during the investment discussion, but given the COVID and the timing of that seems like an important piece to me.
Yep, looking at overall risk. Now, most of the time we do those studies 3 to 5 years, and because they're pretty big, they're involved, they interact with your actuary. But importantly, what they do is they really focus on like a 7 to 10 year time horizon. They say, okay, we're going to have bumps in the road, but how do we win over 7 to 10 years? COVID hasn't completely changed the outlook for 7 to 10 years. It has for 3 years, it has for 2 years. It's increased volatility. And I think it's impacted your bond portfolio,
right?
The earning power of your bond portfolio really meaningfully. Yeah, if we did that study again right now, Jeff, I don't know if we'd come up with a different outcome. It's kind of where I was heading with those comments.
All right.
Right. I mean, the couple of interesting facts just have come out as you look through year to date. Our projection for stocks when we did your study last year would have been around 7, and for bonds would have been around 375. Sounds pretty rich. Now at the start of this year, we kept our stock return at 7. We reduced our bond to 275. Now, since this giant V-shaped move in the market, what's happened? Stocks are up almost 6% for the year. Bonds are up almost 8% for the year. So 8% instead of 275. What we've done is pull the next couple of years' return forward for bonds, and probably lowered the longer-term expectation there. But the stocks, I'm going to argue it's probably not going to be dramatically different from where we are now. So if anything, it's probably going to be pointing you in a direction that's pretty similar in terms of risk seeking to meet your needs.
But that's a really important question, Jeff, and the biggest question. So thanks for bringing it up.
Well, I think we're looking for someone to jump in. I'm not quite ready to do it yet, but yeah, I'd be interested in asking Doris how she feels about all this.
I'm a bit of a index fund investor. I have all of my active management dollars allocated to the small and mid cap areas of the market where I believe that there's more opportunity for a mid cap or small cap manager to add value. And I don't do any personally active management in the large cap space. That being said, we've had very good active managers even in the large cap space. This would simply be saying if we're going to pay the cost for active management, we're going to put those active dollars in those markets where we believe that there are some inefficiencies and active management could provide us with more return or bang on the buck. I'm fine with really any of the proposals or even the structure as it is. The point of reviewing it is due to the equal weighted S&P 500, even though that's a passive product, it's giving us more of a small cap tilt than maybe the board had intended. And I think Kellen wants to address that because we already do have a sufficient allocation to the small cap market. So I don't see the need necessarily for the equal weighted fund. And then it's really part of board preference, whether you prefer to go all passive for your large cap allocation or what other options might be listed here. I don't have any actual personal experience with a plan that uses the low vol methodologies or products out there, so I can't really speak to those. But I think Greg made a good point in that they've had some past success, but they maybe really don't have a long enough track record to be super confident that they're going to be able to maintain that going forward. So this might not be the time to move into a low vol product, but I'll defer back to Greg's comments on that.
One comment I do want to make also, just so the board kind of is aware of that, we've used the large cap managers mostly for liquidity purposes. And so these scenarios that you see in front of you, they're not going to affect that. So I just wanted to throw that out there. The idea of losing the equal weight or of losing Harbor Cap or Boston, I would say the board should feel comfortable knowing that going into the Vanguard S&P that we're going to have the same level of liquidity that we currently have today.
That helps. Thanks, Robert.
I mean, most of the time we're pulling from Harbor Cap or the Vanguard S&P as it is now.
Yeah. So it sounds like a recommendation to eliminate the equal weight mandate and the active large cap mandate. And
that's expressed in alternative 2 on the screen.
Right. And the only caution was, and I can't remember who it was who said that with what's going on with COVID, this might not be the right time. Was that Lee? But if we're only putting 5% in and spreading this out over a good period of time, that doesn't sound like too radical a move. It just sounds like stopping the redundancy, particularly the third time over of the small cap weighting. So I'm comfortable with alternative 2.
M as well.
Greg, how long of a period of time are you recommending we take, like 5% and 5% how often to switch everything over?
I think if you do 5% a month, that would make sense. So, but what's hey Jay, what's 3 times 17.5?
It's less than 60 and it's more than 50. How about that?
52 and a half, I think.
Hey, you're our quant guy, Jay. Come on.
I was giving you how I would do it, which I'm a magnitude spotter that I hone in. I would say it's about 52 and a half, just like Claire says.
It's
and you can see
52
no hands. I'm not calculating anything.
Yeah. So what might make sense if you make 10% a month for 5 months.
Sounds good to me.
And yeah. So your motion could be to adopt alternative view 2 and then dollar cost average into the new allocation over the next, and give yourself a little bit of latitude for operational things and, you know, the holidays, or say over the next 4 to 6 months or something like that.
So I move that we adopt alternative 2, eliminate the equal weight mandate and active large cap, and reallocate to the S&P 500 index over the next 6 to 8 months.
Is there a second?
I'll second the motion.
Okay. Is there any discussion on the motion? Already had a lot of discussion.
If you're uncomfortable, this is the time to speak up, board members.
I would just ask, when you're doing 5% a month for the next few months, would you be looking at how each one of these firms are doing, or funds are doing, and not take it equally from each one of them, but take it from one when it's most advantageous?
Yeah, we'll help.
We can definitely do that. Yeah, that's what I'm sitting here thinking about.
We can help you make a glide path to get to the new allocation. And in so doing, we'll make sure that we're not making a bet on what we think will do better over the next few months, right? So it'll be just kind of shrinking it and staying style neutral over the next several months.
I mean, if you really want to time the market, you sell whoever just did the best.
Yeah.
And we've done that with our rebalancing and when we pull cash for benefit payments, and that will still, in some regards, be continuing even during the transition period, certainly.
Yeah.
Madam Chair.
Okay, any more discussion, or did you want to speak, Lindsay?
Yeah, just as a comment on the motion that's presented, I think that, you know, we are a very deliberate board in the actions that we take in my short time on the board. And I think that the repeating conversations since I've been on the board have been about diversifying investments categories and continuing to limit volatility, which is a little bit beyond where we want it to be. And I think that this move and this motion are both consistent with those goals. So.
Any other discussion? Judy, would you do a roll call vote for us, please?
Yes. Ms. Schattmeyer, do you agree?
Yes.
Ms. Forrester?
Yes.
Ms. Cavanis?
Yes.
Mr. Parker? Lee?
Restroom break, Lee.
He's muted. He's muted.
You're on mute, Lee.
I'm trying to find him so I can unmute him, and I'm not seeing him.
He's there.
Unless his call is
Oh, he was talking about that the PG&E was coming.
Uh-oh.
Oh.
Yeah, I think we've
I
lost
see him.
Yeah, I can see him.
He gives a thumbs up.
Okay. Thanks, Lee. We gotcha. All right, Ms. Smith,
Yes.
Mr. Cromer,
Yes.
Mr. Knudsen,
Yes.
Ms. Harris,
Aye.
and Mr. Jurdy.
Yes.
Thank you. Approved.
Okay, motion passes. How's everybody feeling? Would you be, after we say thank you and goodbye, do you want to Callan, thank you so much. Do you want to take a break or do you want to keep going? What is your pleasure?
What time is it?
It is 12:28.
I'd like a quick break anyway.
Yeah.
Okay.
Yeah.
Okay. I want to thank Greg and Claire and Jay very much. That was quite involving. We appreciate presentation.
You're welcome.
Thank you very much.
Yeah, thanks.
All right.
Thank you all.
Good to see you.
All right. Good to see
Stay
you all.
safe.
Stay safe. Watch out for
Yep.
fires. Yes.
Yep,
Take
yep.
care.
Take care.
Okay.
Bye.
There's big fires going on the way south.
Oh, no.
There's an evacuation order for Northwest Sonoma County.
Yeah.
It sounds like a little bit like a little war zone over here at the office with the planes constantly flying over us.
Oh, is that right? Mm.
Okay.
I need to check on my daughter.
Yeah. Do you want to take a break and reconvene at 12:45? Does that work for everybody?
What? Yeah.
Okay.
How much longer do you think we're gonna go?
We've got, let's see, let's see.
I think it should go pretty quick, Doris, don't you think?
Do you want to just keep going?
I'm not suggesting that. I'm just saying,
Yeah, can we do maybe 10 minutes if that way?
Yeah.
Because I think I might have a 1 o'clock. I need to look. I thought I had a 1 o'clock, so.
I think you could be done by 1.
Okay. We'll do a 10-minute break and get back here by
Maybe I'm underestimating.
12,
It looks like there's 4 items left.
12:40. We'll come back 12:40.
Okay.
All right.
Thanks.
Thank you.
Received no requests for public comment, either before the meeting or anytime during the meeting up until this point. And Richard Shoemaker did have to leave the meeting during the break. He will not be returning.
Thank you. Okay, we're going on to agenda item 7, discussion and possible action regarding State Association of County Retirement Systems Board of Directors elections 2021. Doris, would you mind taking over on that?
Certainly, thank you. The materials were provided back in June. At that point, the board had asked us to bring this back in October. As the materials indicated, the election was going to occur at the November SACRS. However, what didn't get included with the materials in June was the cover email that said they needed this information by July 31st, which we did miss. But SACRS is waiting for our proxy and the vote on the ballot slate to wrap up what they need to do on their end, and they've agreed to give us this meeting to get these items in order.
And so has everyone received a copy of the ballot slate?
That should have been provided in the materials, was it not, Judy, right?
Okay.
You were muted, Judy, too.
Sorry, it is in your meeting materials, including the email that we missed.
So is there a motion?
Ms. Harris, you're muted.
Here, I got you, Jerry.
Submit the, our ballot. We approve the slate as presented, and especially with the candidate for secretary.
This is Sherry.
With the gold star.
Is there a second?
That's tongue in cheek. It's been a long meeting. I move that we approve the nominating committee recommendation of the slate.
I second. This is Sherry.
Am I still off?
No, you're on. Is there any discussion on the motion? Okay.
Just when will the candidate for secretary move up the chairs further?
Well, I'm open for suggestions. It won't be this time, but I could do it next time.
Sounds good.
Okay, Judy, could you take a roll call vote, please?
Yes. Ms. Shatmeyer?
Yes.
Ms. Forrester?
Yes.
Ms. Cavanis?
Yes. Or maybe
Mr. Pepper?
Yes.
Ms. Smith?
Yes.
Mr. Cromer?
Aye.
Mr. Knudsen?
Yes.
Ms. Harris?
Aye.
And Mr. Jurdy?
Yes.
Okay, motion passes.
Approved. We do need to have that discussion about proxy vote and direction.
Okay, so according to Selema, the administrator for SACRS, she says that there's not a conflict of interest. I'm the default delegate to vote because all I am in the SACRS board is the secretary, but it's at the pleasure of the board if you would like to have another person do the vote. That would be just as well. I would feel, I'd feel very good about that if somebody else were appointed to vote in the SACRS business meeting at the next conference.
Has anyone expressed an interest, Catherine?
I'm not as far as I know. I know, Tim, you've done it in the past, but it's it's up to you. It's up to the board.
I'll just weigh in if I'm understanding it correctly. I don't see it as a conflict because you're just voting the direction that the board has given you. So I agree with Salema. So I don't see it as an issue, but if you want to avoid a possible appearance, somebody else could step in.
I'm good with Catherine. Do we know if it's still going for sure, or as far as the conference, or is it going to be virtual, or?
You know what? I really don't know. We're having a meeting next Tuesday, a board meeting, and we haven't. We used to have them almost every month, but we haven't done that because of COVID. And it's going to be a Zoom meeting, so I don't know for sure. It's supposed to be in November, and I don't know that it will be an actual in-person meeting.
We actually have time to decide that. I mean, I'm fine with you doing it. I don't know if anybody else has an issue, but we can take that up even when it gets closer, right, to find out what's going on with it.
We have to. It was due. The form was due July 31st, so we have to.
For the delegate?
Yes, we have to submit today.
So in light of the meeting, Sherry, they decided that they would go ahead and hold the board of directors elections now instead of waiting until November.
Okay.
Okay. I didn't even wasn't aware of that. They're going to hold it. You're saying they're going to hold it now? Well, they're waiting for us.
They're waiting for us to cast our vote by the ballot that is in your packet.
Right.
It basically said, in an effort to maintain current business continuity, they've decided to move forward with an election via electronic proxy voting.
Okay.
And we're required to get this into them today.
What about that?
I'm fine with Catherine doing it, but does someone else want to do it?
Jeff, do we need a motion, or is it just, we decide?
For the proxy?
Yeah.
No, I don't think we need to do that. I think it's understood.
Yeah.
Okay. So if everyone's okay with it, I will.
Yeah.
Go ahead and
Yep.
do it.
Good.
Thank you. Thank you, Catherine.
We appreciate it.
Yes.
Thank you so much.
Hey, Catherine, just to clarify, I think it really means that we're putting forward a ballot from the board, and then your name will be on the ballot as our proxy, but we're actually voting by ballot.
Yeah. Okay. Thank you. Okay. Moving on, we're going to the consent agenda. And is there any discussion or action regarding any agenda items in the consent agenda needing separate action? Okay. So by unanimous agreement, we'll move on. We'll accept the consent agenda and move on to the administrative report.
Thank you, Madam Chair. Sorry about that, trying to get the administrative report open. We will have an election for general and retired members for board trustee. The notice is going out tomorrow that the election is gearing up. Candidacy forms will be due by September 11th, and then if the person is running unopposed, they'll be moved to the vacant seat. Otherwise, ballot printing will occur September 14th and thereafter, with ballots being due back by October 9th for the new term that starts in December, I believe. Is that what you do here, or January? By the way, there are some members with expired appointments, and my understanding is the county will continue to allow people to remain on the board due to the COVID situation. However, I would like to encourage anybody who's interested in still continuing to serve to go ahead and complete the county's online application to sit on our board as an appointed member. Between the appointed members and expiring appointments and the elections, we have 7 out of 10 board terms that are set to expire here at the end of November. So as far as an update with COVID-19 for the office, starting July 31st, we closed the office to the public on Fridays. This is in part to allow staff time to work on projects that are backing up here, and we will resume opening Fridays at some point in the future. We're taking appointments only on Wednesdays and Thursdays, and we have designated days that we're answering phone calls when in the office. Otherwise, we do get back to people via phone or email, usually within 1 business day. We've been working with the county to ensure that we have space for at least 1 staff member in the event of a public safety power shutoff to go over to the admin facility and be able to work via their laptop on their Wi-Fi network over there. Depending on the need at the time, our staff can swap out to get whatever needs to be done, whether it's Robert with handling something at the bank and money movement, or benefit staff ensuring that benefits gets paid. So we do have a backup plan there in the event of a public safety power shutoff. We did add a mail drop to our office. So even if we're not here physically in the office, members can drop off items for staff for processing. And we've reduced producing the newsletter to quarterly for the next couple of quarters, again, so we can really try to effectively utilize the time we have on servicing member applications and working on some of our bigger projects, including now the Alameda items. So that was just a quick update. The other item I wanted to mention is we did have a leak in the irrigation system. So if you look at our expenses, we did have a larger than usual water bill and the cost for the repair of the irrigation system.
This is Sherry. I just want to add, retirement staff is welcome to come into our office for if we get to do the PSPS. That's who you guys came here last time, and that's fine. We'll find a place for you to hang out here if you need to.
Well, I know there's much limit on space now due to distancing because of the COVID. So far, they've indicated that we would have 1 space available, but if we can slip in an extra person in your area, Sherry, I'm all for that. So thank you for the offer.
And we can social distance.
We won't need to use it often.
Yeah, and we can social distance you as well. So
great.
we have space. Yeah.
Thank you.
Thank you very much, Madam Executive Director. And is there any more discussion, or is there, and we're open for a general board membership discussion. Yes, Geraldine.
I don't know if Lee is still on or not, but hi Lee.
Hi.
You are really going to be missed.
Yeah.
You know, you've been a wonderful board member.
I'm going to miss the board tremendously. It's really been the best board I've ever served on of many. And you're such a tribute to the county, the cooperation that everybody has, the intelligence they bring. And Quincy, you have learned so much in the short time that you've been on the board. Your questions today about the investments, I was really impressed.
Thank you for saying that. I try.
Yeah, you definitely try. You all try. And it's been such an honor to serve with all of you. Thank you so much. And best of luck to you on your new role of taking over the board for us.
Well, also, if you ever want to come to any of the conventions, you're very welcome. we can bring you as a guest.
Oh, thank you. And sadly,
Parker, I would
I
like
was
to point
hoping
out
that,
that there is a provision where the Board of Supervisors can waive the residency requirement if you want to continue serving.
There we go.
We vote for that.
well, I feel like I'll help you out for a little while, but I think, you know, in reality, moving to Washington, our life is, you know, we're going to have a new center of our universe. And I think it's probably best that somebody locally, you know, if you needed the help, if you really need me, I'm here. But if
Good to know.
you guys are whole without me, that's I'm not required, that's for sure. So
I don't know about that, but oh
Yeah.
well.
Thank you, Lee.
that thing is they all the pension plans in Washington State are under the state pension plan. I was hoping that Kitsap County had a pension board, but they don't.
Well, it's interesting how there are all these variations in structures and setups as far as pension boards go.
Well, Lee, one other thing. I know when you were first appointed, you took the place, well, Kathy did, but of a representative of people who really did not know what retirement law was about, what this pension board did. And it was just a delight to have you come on board and get educated, go to the Berkeley Pension Forum, come back really understanding what it meant to be a fiduciary to our members. And from that point on, boy, you were part of the team. And I think every
good after the it was easy for me to come in as the replacement.
Well, that's true. But anyway, just such gratitude to you for being an outstanding person and board member.
Thank you so much, Jerry.
Thank you.
So now keep coming to meetings remotely, Lee.
I will. That I will.
Yeah.
Check up on you guys.
Well, that's one good thing about this whole crazy setup with Zoom meetings is that it won't be a problem for you to attend.
Yeah, so will this become effective when? When the term, shall I stay on until you have your elections, or what's your pleasure?
Until you're replaced.
That's what it is. For the public members, I think it's
Attorney
until
already
replaced.
threatened me with that one.
Yeah.
Doris, do we need to approach the Board of Supervisors about that waiver, or is that just known?
I copied that language off their website as far as it says in circumstances that they can appoint. I don't think it addresses if a current member actually moves out of the area, and whether or not you wish to continue serving, I think would be at your pleasure, Mr. Parker, until such time as it's the position is appointed a replacement, or if the seat actually sits vacant, maybe Jeff can speak to that. I don't know.
I think consistent with the Searle and past practice, I think appointed members have stayed on until filled. I hadn't thought about the residency piece, and so it sounds like there is some kind of a waiver exception. We can look offline and confirm that.
Or you can do what I did, Lee, and drop off for a few months and then come back later.
Yay.
Are you signing back up, Kathy?
I haven't. Well, I resigned last November when my term was up, but nobody filled the spot. And I did that because I was traveling so much, but I'm not traveling in 2020.
That's good.
Yay, Kathy.
Yeah, well,
so much if we don't lose both of you.
Yeah, that would be wonderful if you would stay.
I plan to for now.
You're a great asset to the board. You should-
Absolutely.
Well,
Good.
thank you. I just, you know, when it comes time to get to Hawaii and New Zealand and everywhere else again, though, I might
Right.
not be around. So.
But yeah, but who knows how long that's going to be, right? So we get
True.
you. That's good. We'll take you.
Yes, we will. Wonderful.
Okay, is there a motion to adjourn?
So moved.
A second? Any discussion about the motion? Okay.
Good to see everybody.
Yeah, take care.
Bye, group.
Okay, bye.
Bye.
Be safe.
Stay safe.
Yeah.
September 16th.
Bye.